Good morning and welcome to our update on global capital markets with our CIO of Multi Asset, Gregor Hirt. Today we want to hear from Greg his view and the Multi Asset team's view on recent market developments, their outlook for the coming months, as well as what this means for their positioning in multi-asset strategies. So Greg, what is your view on the recent quarter?
Well, looking back since the beginning of the year, the flagship indices for both the US and Europe appear almost equal. The Euro Stoxx 50 is trading at minus 16%, so is the S&P 500 since the beginning of the year. However, this is primarily a currency illusion because if you look at both indices, including forex gains, the S&P 500 is about 15% ahead. The markets were clearly oversold mid-year. All it took was some more constructive numbers on the inflation front to wrong-foot severely underweighted investors. In particular, systematic, quantitative and rule-based investors were forced to re-enter the market. It is estimated that this led to over 100 billion in additional purchases in the stock market. However, this phase rapidly came to an expected end. There is thus a risk of further weakness in risky assets, especially if the US Fed reaffirms that the battle against inflation is not yet won. Indeed, we understand the price gains in Jolly mostly as a technical bear market rally, mainly driven by the expectation of less restrictive central bank measures, and which, in our view at least, is hardly sustainable.
Thank you. That's very interesting. With this in mind, could you give us some idea on what you expect for the coming quarter?
Well, macroeconomic factors give little reason for optimism. Indeed, we have historically high inflation, which poses a risk of recession due to central banks' reaction, combined with unresolved supply chain problems and ongoing geopolitical tensions. Both the US and Europe are facing very different challenges, yet we are currently coming to the same conclusion. We are cautious on both markets. We rate the recession risk for the Eurozone as higher than for the American market. In fact, the US is significantly less sensitive on foreign energy supplies than Europe and therefore more prone to a boom and bust reaction. While in the EU, we could see actually a longer structural weakness phase. We also expect further negative corrections in companies and analyst profit expectation, more so in Europe than in the US. But nevertheless, from a valuation perspective, European companies are more attractive and under-owned by investors. So that overall, we actually prefer Japan, which is benefiting from cheap valuation, a still supportive central bank, and a weak yen. Actually, in Asia, more broadly, we see slightly more potential for equity investing than in developed markets, as central banks adjusted to the new inflationary environment ahead of developed markets. Obviously, we follow with great attention the COVID reopening and also the evolution of the real estate correction in China, a critical factor for the region. With respect to fixed income market, in our opinion, high inflation rate will continue to keep pressure on the Fed and the ECB to pursue a very restrictive central bank policy. And of course, the resulting rise in interest rates will depress bond prices. So we are most cautious about government bonds from the so-called Eurozone periphery, and Italy in particular worries us. In addition to the risk of a potential Eurosceptic right-wing government, Italy is suffering greatly from high gas prices.
Understood. Given these developments and your expected outlook, can you give us some insight on how you are positioned currently then?
Well, that's a very good question. And as already mentioned, the risk of a recession are, in our view, high. And we remain rather defensively positioned with regard to equity investment in the short term. And we wait actually for better entry points. However, even in difficult market situations, there are always segments of the market that outperform. And this time, the dividing line could be less between big and small companies and more between regions, sectors, and style. For example, the energy sector, both fossil and renewable, has benefited from rapidly increasing energy prices. This is likely to remain the case for some time. Likewise, defensive stocks, such as consumer goods or healthcare sectors, can generate relatively stable cash flow, even in a recession. Looking more generally, an important theme at the moment is globalization. Global supply chains, which have enabled significant gains in productivity, are now being shortened again, and regional production is coming into focus. This, in turn, leads to an increased use of robots, especially where labor is expensive or simply scarce. Another thematic portfolio component consists of alternative investments. For example, multi-asset long-short strategy, or those that systematically collect volatility premium. They diversify our multi-asset portfolio.
That sounds promising, even if the overall outlook is blurry. Thank you very much, Greg, for these very interesting insights.
I appreciate your time, and thanks to everybody for listening.